everyone. I'm Nancy Lee, Director for Sustainable Development Finance here at the Center for Global Development, and I want to welcome you to this discussion today. Our focus is on what I would describe as a neglected aspect of the MDB role in catalyzing private finance. That is their impact in building markets beyond their participation in specific transactions. We know at this moment lots of attention is being paid to scaling MDB private finance mobilization, and of course, for very good reason. We're at the 10-year mark of the billions to trillion vision of 2015, and the data are mostly pointing in the wrong direction. SDG finance gaps are widening, not narrowing, as countries are knocked off their growth and poverty reduction paths by multiple external shocks. Foreign investment in emerging market debt and equity is flagging. The total in 2024 was $274 billion, which was a striking $100 billion below the value on average in 2019 to 2021. We've seen that the world's largest aid provider, the United States, which accounts for about a quarter of global aid, is slashing its funding. So large increases in concessional finance for blending are unlikely at this point. Judging from recent pullbacks from net zero partnerships, big private investor commitments to climate-related investments may be softening. Long-term growth prospects for lower middle-income countries and low-income countries are increasingly uncertain as the manufacturer's export-driven growth model confronts ever more obstacles, including trade obstacles. And higher for longer interest rates suggest little relief from low-income debt burdens, especially given heightened inflationary risks in the United States. So we're in a period where stiff headwinds are rising that simultaneously constrain mobilization while increasing the need and importance of it. So this is the right time to be grappling with new approaches. Blended finance, deployed transaction by transaction, has proven hard to scale. And we've seen a welcome shift to portfolio approaches that are more scalable, giving investors opportunity to invest in pools of MDB assets, transferring portfolios or their risks to the private sector, and even letting private investors help capitalize MDBs through issuance of non-voting hybrid capital. But in theory, the greatest potential for scale should come from an MDB focus on markets rather than only individual transactions. MDBs can combine their direct finance to the private sector with their broader work on investment climates and project development to build and shape markets. That is, they can generate positive spillovers that influence the behavior of other market actors. So what kind of market building activities are most effective, and how should success be measured? And that's the topic for today. So here are a few questions it seems to me that MDBs need to be asking themselves. Are they taking some of the first mover risks where potential market impact is very large? First movers face high costs and uncertainties, which give later entrants profitability advantages. So MDBs should be sharing some of those costs, preferably without raising barriers to entry for later firms. Are they building market infrastructure and solving collective action problems, the interdependence across multiple actors in building markets? Are they filling information gaps or reducing misperceptions about risk and potential profitability that block private capital flows? Are they targeting capital market gaps that block the development of other markets? A lack of venture capital and early stage finance, for example, stifles innovative firms before they can reach profitability? And are they lowering transaction costs and making transactions more easily replicable? So clearly, these are difficult questions to answer. Measurement and attribution of market impact are hard. But to quote a paper co-authored by one of our panelists, Alessandro, lack of or imperfect attribution should not stop investors from developing metrics and targets. So in this conversation, we'll approach these issues from the perspectives of public and private investors that are leading thought and practice leaders. The aim is to talk about market impact assessment, how ex-ante scoring influences or should influence investment decisions, but also about what the early data are showing about where we see real evidence of market impact. So let's plunge in, and I'm delighted to introduce our panelists in alphabetical order. First, we have Chris Eleftheriades, who's Executive Director of Lions Head Global Partners and Research Lead at Mobilist. We have Elvira Erlings, Chief Investment Officer of the ILX Fund, Alessandro Maffioli, Managing Director of Development Effectiveness at IDB Invest, William Perodin, Managing Director of Risk Control Limited, and Maria Smith, Chief Impact Officer at BII. So what we'll do is we'll have a conversation first with our panelists, and then be thinking of your questions, because I will preserve time to come to you with questions. You can use the link on the event page to ask questions, or the YouTube chat. So I wanted to start with William. William, you and your team, in collaboration with Mobilist, recently produced a paper that scored the market impact of 9 innovative deals. Tell us about how you did the scoring and what you found, and draw some implications for us for how MDBs can most effectively unblock obstacles to capital market development and investment in emerging and frontier markets. So over to you, William.
Thanks, Nancy. So we're a firm of structurers and financial modelers. So we work closely with MDBs on risk strategy issues, but we also are very involved in evaluating transactions, either for MDBs or DFIs or for other investors. So we're our perspectives on this innovation by MDBs is very much formed and influenced by our experience in working in private sector transactions as well. So Mobilist asked us to look at demonstration effects, how DFI transactions could boost activity after the event. So even if a DFI is involved in the first transaction, what subsequent activity could be generated? And so to tackle that, we looked at a set of transactions over a 20-year period, and we looked at features of those transactions that were positive or negative success factors in eliciting subsequent activity. And in doing this, we were trying to focus on an ex-ante view. So we weren't looking back at transactions and seeing what was ex-post, how things turned out. I mean, to some extent, we inevitably did that, but we were also trying to look at it from an ex-ante point of view. If the DFI was evaluating a transaction, how might it score that transaction? And the reason is that we see it as important that DFIs put in place frameworks for giving a higher priority to transactions that will generate informational or other demonstration effects. So of the transactions we looked at, 3 of them were actually purely private sector, and then the rest involved DFIs in different ways. And we took an approach strongly influenced by the kind of structural decision trees that you see in rating agencies, methodologies. And so we determined what we thought were the key contributors to subsequent impact. And then we looked at how these transactions might have been scored around the time that they were originally designed. And then, of course, we studied how they behaved ex post. And so we emphasize informational effects, both the direct information from providing the revelation of information through market prices. So if something is listed, that provides a flow of information. Even a private deal can have a strong information effect because these worlds of transacting are quite small. So typically there's a few hundred people around the world involved in a certain market on a large scale. And so having roadshows, having wider dissemination is important. The second key thing is obstacles overcome. So that if a transaction has cleared the way by persuading the rating agencies to adopt a new framework, or by solving a legal problem that was previously an obstacle to progress, that removes an obstacle and makes it much more likely that there will be follow-on activity. And then profitability and impact are key because people want to repeat the transaction if it's profitable for the private sector and if there's an impact for public sector entities. And lastly, something that, in the various interviews we did with investment bankers and people involved in these transactions, an important thing is just the reproducibility. Whether there's a basic simplicity where, you click a switch and people realize that this is feasible, and then a reasonably wide group of people are able to do transactions at that time because the framework or the approach is a known one and it's feasible on the balance sheets of a set of institutions. So those were the types of things we looked at.
Thanks, William. So demonstration, effect and info, and you mentioned road shows, the new approaches that make things easier in the future, the profitability potential, and the replicability. So those are sort of that's a good taxonomy of the kinds of things that can change markets. So I want to turn now to Alessandro at IDB Invest, which has a new institutional strategy, which shifts to the originate to share model and puts mobilization very high on the priorities. So how does that affect how you think about market impact? How do you measure it? And how does it affect the decision making in terms of choosing which investments to undertake? And how are you dealing with the challenge of quantifying the impact? And also, how much information are you publishing?
Thank you. Oops. Thank you very much, Nancy, for the invitation, the entire team for the preparation, and the panelists, co-panelists to be here. So yes, I think this is a very exciting topic for IDB Invest. I would say since the beginning of the creation of this organization, 2016, as you know, this was the result of the consolidation of the IDB Group private sector activity into one organization. We had this topic of systemic impact at the center of our strategy, and we always look at this with two lenses. One is how can we make sure that we leverage our own account resources in a way that we can mobilize and catalyze resources towards Latin America and the Caribbean. So in a way, creating, if you want, a market of investors that look at impactful projects in Latin America and the Caribbean and decide to move in, removing, as I was mentioned before, lack of information, maybe a perception of risk with reference to certain markets that are untested, and so on and so forth. The other lens we used was always to, not only we want to catalyze and mobilize resources to come with us in investment, or now even more after us, or using our portfolio to engage with the market in Latin America and the Caribbean, but also how do we identify projects that are impactful in the sense that they have a market level effect in the systems, industry sectors or market we are investing in. So, of course, the first lens of this has been even more emphasized with this new business model, the originate to share, where very explicitly and very intentionally, IDB Invest is changing the perception, the mission of itself as not only an investor in Latin America and the Caribbean, but really a conduit for other investors to invest more in the region. And so in that sense, the model is based on the idea that not only will keep our focus on structuring operation that have a big component of co-financing or mobilization within the structure of the transaction of our investment, but also that we make our portfolio available for our investor, as you mentioned, to invest in that so that we free up capital in a way, have, if you want, project mature, being attractive for other private investors within our portfolio. When they are within our portfolio, share those, maintain a share of it so we can maintain that critical part of monitoring and all the standards that we require that I think are important, and move on to new markets and new investment. The model will be, for that reason, be based on, of course, in taking more risk, a stronger emphasis on equity, on guarantees, and a stronger emphasis on upstream work. The point you mentioned about how do we, in a way, also create markets by not only the way of financing investment into those, but also creating the capacity, the capability, the condition, the business environment that is needed for that. And of course, in that, and I think we're very proud of, we see ourselves as really a part of the IDB group. So the cooperation, the synergies with the public sector part of the group will be crucial, because we know that in a way to be systemic in market, you need private sector investor, but you need also to have a public sector that favor an environment and regulation that are favorable for this investment. On the second part, so in that sense, we're being very much focused in building also markets in terms of facilitating access to capital markets for the region. A success story, I think, has been the work we have done in terms of the thematic bond market. We've been the first one investing to those, creating, and again, not only investing, but also creating the capacity, the capabilities, the frameworks, the demonstration effect for more and more issuers to issue those type of asset class that has grown very, very rapidly and very quickly. And I have to say that we have been really one of the first mover, taking one of the first risk with guarantees as well, and with technical assistance so that we could create the market. Other example is, for instance, when we work as an anchor investor for large infrastructure project, issuing social bond, that then can be placed for institutional investors to invest in those. And in a way also connecting international resources with issuance that then can be also denominated in local currency. That is something else we've been exploring and very successful in terms of creating this new, William was mentioning this, how do we create a new also financial vehicle products that can facilitate the capitalization and the movement of the resources towards the region. On the other angle, on how do we select projects that are catalytic or they have systemic effect per se, that in our impact rating system is called the Delta. So it's the tool that we use to measure both ex-ante during the operation and up to the operational maturity when we evaluate their success. We always had an assessment of both what we define the direct effects on direct stakeholders of our intervention and an analysis of the systemic or market effect of our transaction. I have to say, you already quoted this paper that I had the privilege to quote with colleagues from BII, EBRD, and IFC. Pretty much we follow what is the call to action and the practice that we suggest there. First, have a clear tier of change. Market effects are in a way that can come into different fashion. So be clear on what you're trying to achieve and what are the mechanisms that you're trying to trigger. So you're trying to create a new market by virtue of introducing a new product or new innovation or new processes. Okay, so what is the new product you're introducing? Is that really new to the market? And what is the likelihood that that product can be replicated? And also be careful not to create any, as you say, entry barrier on the when you support a first mover. Make also sure that that is done in a framework and environment where competition, the competitive pressure that you want to create is actually there and can trigger other investors or increase linkages into the value chain. So that is something, for instance, the part of innovation, new products and new processes, we've been working a lot. I think there are cases we've been even looking at investment that can be transformational for entire region or economy. Comes to my mind the example for instance, the work we've done with the pulp manufacturing based on eucalyptus plantation that we've done in Uruguay and Paraguay. That is the introduction of a complete new product where you have a country that has two countries that are conditioned to have that kind of production, vertically integrated system, where you have a value chain that's being created. And also you have skills, for instance, in Paraguay, where this investment would be basically the first manufacturing investment, creating manufacturing jobs and skills that are not present in that area at the time. Again, the synergies public-private, that could be extremely important. We saw that to be systemic. For instance, you cannot be focused only on one investment. You need to think about the system. So how the logistic would work. So again, in the current version of our Delta, we look at innovation, market linkages. In the new version of the tool that we're actually developing now, we're going to look even more to this aspect of how we can trigger and work on synergy, private and public. Demonstration effect is also extremely important. We always had in our impact rating system how we, for instance, test a new regulatory framework. I was the first mover in a regulated sector where other investors may be, I would say, skeptical or cautious to say, we understand that the government, for instance, the government of Uruguay introduced a new regulatory framework for renewable energy investment. Is it solid? Is it reliable? Can we invest with certainty in that? And that is, again, for us, has been a success story in creating a market because we were among the first mover in the first investment. The public sector side, of course, with the proper division of labor and internal Chinese was also advised before the country in terms of how they could develop a regulatory framework for these investments. We were the first mover in investing. The first investment, I have to say, maybe more focused on our own capital with some mobilization, and then we kept investing with increased level of mobilization of our investors. I have to say that has been transformational. The country moved from maybe 70% or 80% production of energy in non-renewable to now having a 70% renewable production of energy. So very, very impactful in that sense. So as I say, we look at this with our impact rating system. We look at ex ante. We want to make sure we have an indicator to go to your point. Of course, measuring these effects because they happen in the long run and they are different to attribute can be challenging. But what we do, again, going back to the point of the theory change, to make sure that every step of the causal relationship will lead to this effect, we have one indicator that we can go to and say, yes, this happened. This new product was introduced into the market. And then we can assume maybe that another effects will be triggered by this or measure them ex post. But in a way, we always ask ourselves to have some level of measurement that we can rely on describing and monitoring that value chain. So challenges, of course, are there, the one you mentioned. We have been parsimonious not to over-attribute or over-claim these effects. I think that is important in balancing the fact that you don't want to be shy in trying this investment, but also make sure that you are accountable for those. And in terms of publication of results, we've been very, I would say, successful in publishing the results of our transaction at aggregate level, and also very transparent in what we succeed, we don't succeed. We have a fair rate of unsuccess that we publish, and we explain why. We try to be very thorough in terms of explaining at the sector or country sector level what were the reasons for success and not a lack of success. And more we're publishing information at the transaction level, both ex ante and ex post. That is let's say, a path we're being to in terms of our publication transparency. I think we've improved very, very significantly over the years, and that's something that is an open agenda where we're keep investing. There are certain elements, for instance, our impact rating, because we rate, for instance, the financial sustainability transaction. Some elements of those contains, I would say, information that are sensitive to clients. So we need to we're finding ways to produce those results so that are also cautious of the obligation we have of confidentiality with our clients. I will stop here. So I went a little bit over time, but happy to expand on anything.
Thank Thanks, Alessandro. That was a very good sort of tour of the horizon, which covered both the characteristics of the transactions with market impact, but as well as the work on the environment for those transactions. So that's a lot. And we'll come back to this question of where you see the most potential for market impact. But let's, Maria would love to hear BII's perspective on this. Your impact scoring system tries to capture behavioral changes generated by transactions. So maybe you could sort of give your perspective on some of the same issues that Alessandro was talking about. And, you know, if you have some data on whether your ex ante and ex post scores are aligned, that would be great. And also would love to know what you all are publishing.
Yeah, absolutely. Thanks, Nancy, and thanks for the invitation today. You will definitely hear a lot of synergies with how we look at, you know, this in regards to what Alessandro said. I mean, we did just co-publish this report on driving market level changes in impact investing. So I do encourage everyone to take a look at it. We kind of put together a playbook of how investors should be thinking about this. But, you know, just to step back, BII has an impact framework that we use to measure impact across all of our sectors in our countries. And it has 3 pillars. It has productive, it has sustainable, and inclusive. And so within the productive pillar, this is where we measure the catalyzing markets point and how behavior has changed. And, you know, specifically, we've identified 5 pathways through which these investments may change how markets and players operate. We do recognize within our methodology and within our design that some investments may have multiple catalyzing market pathways, but also the relative strength of each pathway could vary investment to investment. So the weighting of this within our scoring framework varies depending on what the pathway is. But not surprisingly, those pathways are very similar to what Alessandro commented on. So, you know, we look at competition. How do we see new players and increasing competition in our market? We look at replication. So this is where we consider pioneering investments as well as this first mover disadvantage that was referenced. You know, then we look at demonstration, which is almost, I would say, a variation or an evolution of replication as a market matures. So, you know, how is that investment proving that the risk of the market is lower than what is perceived over time? We also look at developing skills and capacity. So, you know, a signpost for success is that a skill gap becomes less of a bottleneck in that market. We've seen this in the textile industry in Bangladesh, for example. And then finally, the 5th pathway we look at is in improvement in enabling environment. And so, you know, although we are mostly focused on the private sector, you know, there are certainly interventions that we do that will focus on the overall regulatory or policy framework. You know, a frequent example for us would be investing in the first public-private partnership in a specific sector or in a specific country. So, you know, those are the 5 pathways that we look at in terms of how this affects our investment decision making. I mean, every single one of our investments goes through this scoring framework. And so, you know, this is considered within each of our investments. We try to set out quantifiable, measurable KPIs for each of those pathways. Obviously, the lead time for measuring those are often much longer than the other components of our impact framework. And so, Nancy, to answer your question around ex post and ex ante, it's a bit early for us to say because we've just been executing on this impact framework since 2022. We were just this year doing our first ex post scoring. And so we haven't seen much of a differentiation yet between ex ante and ex post when it comes to specifically to catalyzing markets. But really, I think that's just because most of the, you know, the signs of success that we have laid out take a much longer time frame to play out. And so the forward looking, you know, I expect that will evolve as we, you know, the next time and the next several times we do the ex post scoring. What I would say is that, you know, this concept of catalyzing markets and in having these types of investments we have been doing for over a decade, even if it wasn't explicitly in our impact framework. And I think, some of the lessons learned we've had is that it just does take time, right? It's incredibly resource intensive and multifaceted. And so you need sort of a long-term collaborative mindset in order to see the effects of these types of investments. In terms of what we are publishing, we've just co-authored this report that Alessandro mentioned and I alluded to in the beginning. We do publish the impact scores of every single investment that we make. So you can go onto our website and you can see, how we have scored our impact, and we will be doing the same for ex post. We tried to do case studies on what has worked in this regard to sort of share experiences. One of the examples that you will see online for us is our GridWorks platform that we have set up. So, one of the things we've been very successful at as a DFI is not being shy of, I think, the work and resources that are needed to create a new platform when we see a real gap in the market or a real development need that an existing investment vehicle isn't well suited to. And so an example of that is GridWorks, which is a platform we set up in 2019. And as most people will know on this call, in most of Africa, the government-run utilities handle energy transmission and distribution. But they're not done often in a very commercially viable way. And so the market for, privately funded T&D struggles due to the high risks and the low returns and this first mover disadvantage that we talk about. And so we set up this platform in 2019 to try to address that gap in the market. And this would have been an example for us in terms of the demonstration effect pathway, where early signs of success will be financially viable, sustainable projects that are created by the GridWorks platform. But in the longer term, seeing GridWorks being able to attract funding from other commercial players and other strategic partners. And so these are the things that we will sort of be measuring over time. I will also stop there in interest of time, but that's a bit of an overview about how we are incorporating it into our framework.
Thanks, Maria. And the fact that you publish the impact scores at the project level, both ex ante and then looking forward ex post, makes it very easy for your stakeholders to assess the question of what role market impact plays in your investment decisions, which I think is critical. So let's shift now over to our private sector colleagues. And going, Elvira, first to you. The ILX fund is, of course, a path-breaking opportunity for Dutch pension funds to invest or to participate in MDB syndicated loans. So I'd love to hear sort of a short update about how the fund is growing and lending. And then if you could give us a perspective on market impact. Is it important to your funders? How do you measure it, and how does it affect decisions on participation in syndicated loans? And then we'd love to hear a few examples of where you think ILX Fund has actually had the greatest market impact.
Yeah. Thank you, Nancy, for inviting us to this conversation and for your 3 questions. So happy to give you an update, maybe super short for those participants in the audience that are not yet familiar with the ILX Fund. So ILX was set up a few years ago to connect actually 2 worlds. First and foremost, at that time, the world of the Dutch pension community that was looking to an increasing extent to allocate more towards investments yielding double returns. First and foremost, a decent financial return, but also having a societal return. So a measurable contribution to positive environmental and social impacts. And we saw that momentum at ILX to connect that desire of those pension funds with what we would call the best impact financiers globally, the MDBs and the DFIs that are active in those countries where the SDG needs are highest, that combine that with decent returns and at the same time highest standards when it comes to environmental and social issues, but also very robust credit processes. So in that journey to combine those two worlds, we were supported by the Dutch, German, and UK government, and this all resulted in the ILX Fund 1 launch early 2022. It is a fund that is a emerging market focused fund. It consists of B loans. Indeed, as you said, we participate in loans that are being originated and structured by MDBs, by DFIs, such as IDBFS, such as BAI, such as the EBRD and IFC. They remain the lender of record. They are the face towards the end client, but we, on a funded basis, participate in the loans that are arranged by the MDBs, and we share in the same terms and conditions. As cornerstone investors in that fund, we have pension fund ABP, which is Europe's largest pension fund. We have other Dutch funds that followed along early 2022. And most recently, we were very happy to also welcome new Danish pension funds. So we have now a 1.7 billion commitment size to invest. So far, in 2.5 years, we have, for these pension funds, built a very diversified portfolio. We have over 50 loans in our portfolio across 20 countries, across 7 sectors. So again, very much diversified, all alongside the MDBs and the DFIs. Our largest exposures in the financial institutions and infrastructure space, followed thereafter by renewable energy and agribusiness. Regionally, we have quite some exposure in Central and Eastern Europe, Latin America as well, followed by Asia and Africa. Just to give you a bit of a snapshot of where we are, who are our investors, and what we've built so far. Then on your question, Nancy, like how important is that for our fund participants, impact, measuring impact, building markets? Maybe a bit of a context. So our anchor investor, APP, they've recently revamped their impact policy. Amongst others, they have committed themselves by 2030 to achieve, amongst others, a 30 billion investment volume in what they would label as impact investments. They would define that as those investments that contribute positively to solutions that address environmental and social problems without obviously sacrificing returns. And they've also specifically identified an investment target of 11 billion towards climate transition, but also nature and biodiversity conservation. So that is at the heart of what our anchor investor likes us to do. It's in the mandate that we have received from them. For us at ILX, this meant that we fully integrate that in our investment screening, in our monitoring, in our reporting. It was mentioned before, we have revamped our whole theory of change for every single investment that we do. We identify upfront, indeed, the expected sustainable economic development outcomes per transaction. We select the relevant impact indicators. We report on baseline numbers, on expected results. So all in all, very much at the heart of what our investors like us to do, to have a measurable impact, to report on it. On market creation specifically, it's not a specific target that we have, but I think through working with the MDBs, I think we have great examples where, as was mentioned before, in terms of innovation, demonstration effect, replicability, I'm happy to share like 3 examples. So the ILX Fund, again, on behalf of these Dutch and Danish pension funds, we have participated in a loan to a plant in Pakistan that is the first in its kind that will design, construct, and operate a sustainable aviation fuel plant. It will use cooking oils as a feedstock and transform that into aviation fuel. It's not a technology that has been rolled out on a large base, but with the strong sponsors, with expert technology providers, all gathered together with the MDBs, they are structuring this all well, having off-takers that are also committed to be part of that whole financing. We were also able to co-financing along, and I think it's a great example of where a new market hopefully will take off. Especially, focus on that aviation sector that needs more carbon transition and decarbonization. Another example is where in Latin America, Central Asia, we have provided financing for the rollout of large-scale battery storage systems. Again, on quite a large scale. There was a lot of work by the MDBs also on the public side, on the off-taker side, to provide for specific tariffs that are being used whenever the batteries are being activated. Again, we hope to see that more and to have that structure replicated. And maybe a final example, also quite exciting. We have recently provided financing to a bank in Ecuador with one of the MDBs that was specifically focused on the conservation, restoration and protection of biodiversity. It was the first loan, as far as we know, in Ecuador with that component specifically earmarked to that financing. Obviously, the country is known for its biodiversity, but it's also, unfortunately, is quite some loss in the country. The facility that we were part of also consisted of advisory services by the MDB to help the bank to identify the right opportunities and clients and projects. It is our first transaction in our portfolio with a biodiversity angle. So again, we hope also by participating ourselves to give validation to these kind of transactions that we have an appetite from a private sector to be in those transactions as well, and hope that we can see more of those examples going forward. I hope that was useful for the discussion. Thank you, Nancy.
Very useful, Elvira, and those were very interesting examples. The sustainable aviation fuel is an example of a clearly sounds like a first mover, firm. So it's good to hear that the pension funds are willing to take on the risk of those kinds of innovative products, and are confident enough on the returns from those loans that they're prepared to participate. So that's and as well as the biodiversity loan to the bank in Ecuador. Those are great examples of some very encouraging on the potential for institutional investment in these kinds of activities. So, Chris, from where you sit at both Lionshead and Mobilist, and you can explain your dual hat position. Maybe you could give us the perspective of where MDBs could go from here in terms of building markets. What do you see as the kinds of things they should be doing, and the kinds of things they should be prioritizing to increase their market impact?
Thank you so much, Nancy. Excuse me. Thank you to CGD colleagues for the invitation and the opportunity to contribute to what we think is a really important conversation on market building. So as you say, with a company called Lionshead Global Partners, we're an emerging and frontier market-focused investment bank and advisory firm. We work with issuers, with development finance actors, and with donors who are looking to mobilize capital into emerging market and developing economies. And in that context, we're lucky enough to be the research lead for the Mobilist program, which I'll focus on in the context of today's conversation. So Mobilist, maybe it's best to start with unpacking the acronym, as is often the case, stands for mobilizing institutional capital through listed product structures. And that's really, I think, the innovative part of the program is its focus on listed instruments and public markets. The programme is a flagship initiative of the UK government, but is now implemented in partnership with the governments of Norway and Switzerland. And it has several components. The first and the majority of the programme is really focused on investing in innovative transactions, as we've been hearing about from other colleagues, already in this conversation, that have potential to scale and be replicated in the market. So the majority of the program is an investment platform. The program also provides technical assistance to support the listing of these products, and provides policy and research support. And that's where Lionshead comes in as the research lead. In that context, we were lucky enough to work with William and the team on the piece that he presented and spoke about earlier. And it really highlights, I think, one of the key reasons that Mobilist is focused on the public markets, so listed stock exchanges and listed debt markets. And that is the transparency of the public markets. They bring disclosure by default. Once listed, companies and products are pored over by armies of analysts, and then the daily pricing as instruments are traded, and create this sort of track record and risk information that investors we think really need to see. And so because of that transparency, we think public markets are the perfect venue for the generation of demonstration effects, as various colleagues have touched on already. In turn, those demonstration effects were really intended to correct the information asymmetries that we hear so much about, the misperceptions, if you like, of emerging and frontier markets that prevent larger allocators in particular from moving towards the frontier end of the spectrum. So what we're talking about here, I think, in the context of today's conversation, is really thinking about investments that can mitigate those information asymmetries and so build financial markets for EMD assets, for these developing country assets. So you asked where MDBs and DFIs have been effective, and I think actually today's conversation is demonstration in and of itself of the progress that the sector is making and the community is making. There's been no shortage of strategic commitments to building markets over recent years, but increasingly we're seeing practical approaches being tested and scaled, and that learning being shared among the community. And we're really pleased to see that happening. We hope that Mobilist research is contributing to that learning. And today's session, I think, is also a good example, but also highly commend the paper that BII and IDB Invest colleagues have touched on their work with IFC and EBRD on how to think about impact at the market level. So I think at the sort of community level, there's some really positive things to reflect on. I also want to share one investment from Mobilist's own portfolio that I think highlights several of the aspects of investments that we think make them more likely to generate those market level impacts than others. And that was Mobilist's investment in the equity tranche of an infrastructure asset-backed securitization listed in Singapore relatively recently. So this is a transaction that was put together by Bayfront Infrastructure Management. The underlying assets in this securitization are infrastructure debt, so loans that otherwise would have stayed on banks' balance sheets for an extended period. But through this transaction, they were brought into the public markets, and that really brought some transparency and some scrutiny to the performance of those infrastructure assets that previously wasn't there. And there are a few reasons that we like this transaction. I think the first is that Bayfront came at this problem with a very clear strategy and a very clear scope in the problem they were trying to solve. And that was recognizing the big funding gap in the infrastructure sector, and had a very clear solution in mind, these infrastructure asset-backed securitizations that they thought could help to fill that gap. So clear strategy and scope we think is important. The second is a great example of collaboration between development finance actors. So Mobilist was involved in this transaction, which was the fourth in a series of transactions sponsored by Bayfront. But Bayfront has also received direct and indirect equity contributions from MDBs. Garanco, a member of the PIDGE group, provided guarantee cover. And one of the MDBs also invested in the AAA notes. So it's a really nice combination and partnership between development finance actors. And because the notes were listed, there's also a very high degree of transparency to come back to the point of the advantages of public markets in transmitting those demonstration effects in this regard. It was also important, I think, to meet investors where they are in terms of how that information is distributed. So this wasn't information by annual report, if you like. It was information that's transmitted in credit rating reports, new issue reports, prospectus. So all formats that investors are used to poring over and receiving information through. And then finally, I think it's important that even though this was the fourth of a series of transactions, there's no shortage of additionality in our view. So I think William, in his research, also points to the need for clusters of comparables that allow new issuers and investors to have confidence that a pioneering transaction was not just a one-off. And we're starting to see this structure replicated in other markets in the region. So I think that hopefully captures some of the reasons that we like the Bayfront transaction and others like it. I think there are a couple of areas where the community can continue to develop, as you asked, Nancy. So first, I think really learning from the group on the panel today in how they are systematically appraising the potential to build markets ex ante, and really integrating that objective in a systematic way into decision-making processes. And I think others have mentioned that we don't have the perfect framework here. I think William's research moves us forward, but what we're trying to do is to take this question of market building and demonstration effects out of the too difficult bucket, if you like, and make it something that we can practically work on and try to use to inform our decision making. And then similarly to monitor some of those impacts ex post. And again, this isn't just about celebrating success or commiserating for failure. It's really about learning. So until we're diligent about monitoring those impacts, we think it's unlikely we're going to accelerate that learning. And then a very final thought, I think it's something that William picks up in his research as well, but we're really of the view that performance of these pioneering investments really matters. So I think that means both being robust in the selection of investments when we're trying to generate demonstration effects and have these market building impacts. So we don't give misperceptions or exacerbate those misperceptions that emerging market and developing economies are subcommercial or uninvestable. So being robust in asset selection, we think, is an important investment strategy. But also trying to minimize concessionality. We don't want to send the signal that these are markets and assets that require subsidy. So we think really abiding by the blended finance principles and investing pari passu wherever possible to generate positive information in the market rather than exacerbating those misperceptions. And let me pause there. Hopefully that covers some of the ground you're hoping to.
Very, very much so. And I think your part of what you spoke about was the sort of intersection about between a portfolio level approach, bundling assets, and market impact. So you sort of have two forces that are supporting scale. One is you're dealing with bundles of assets, and the other is that you're creating new opportunities to for the private sector to invest in those assets. So I thought that was a very interesting point. So I wanted to come back to you all now. We're getting some questions from the audience, which I will pose a little bit later. But I wanted to come back to all to go through to look forward, to sort of build on what Chris was just talking about. Where would you focus in particular to strengthen the prioritization of market impact and to achieve to sort of maximize the gains from market impact? What would you change about the system to make that possible, either the way that the MDBs operate or other actors in the system like credit rating agencies? So cast the net as wide as you like and say what you would do in order to maximize impact. So let me come back in the same order. So William, why don't you start?
Okay. So I mean, I think it's important to make a clear distinction here. So what I, because I talked about how to score different transactions, and then our colleagues from DFIs talked about how they look at impact. But I think one should really underline the fact that what I was talking about is a narrower thing. I'm not talking about whether the cement industry in Uganda could be improved by somebody coming in with a new technology. My focus, or our focus, and I think Chris was talking about as well, is narrower than that. But very important is how you think about the demonstration effects of financial transactions. So leave aside whether these transactions, what the ultimate impact is in development terms, and just say, well, if you open a new way of doing a particular type of transaction, can that open new volumes of financing? So you might say, well, that's a less interesting thing than whether we come up with an aviation fuel or cement industry solution that has a real direct development impact. It may be that latter is more important, but I think what I'm talking about is still important and is highly topical, because a lot of MDBs, pressured by the CAF panel report and with sort of new level of imagination in the senior management of lots of these organizations, they are looking at new ways of doing transactions, new ways either of shifting risk off balance sheet in order to create more room for lending, or new ways of just doing transactions that affects financial markets directly by creating precedents, by removing obstacles. I think on my LinkedIn feed this morning, there was a celebratory message from a CFO of an MDB, actually IDB, talking about how new types of transactions had been done by his bank, and that was an important thing. So when we look at scoring of transactions, we're looking at this financial angle. Can one come up with new financing mechanisms in order to create more room? And I think that is a much newer topic than some of the things that were discussed earlier. Super important, but measuring impacts through scoring or whatever, it's not quite the same as what I was talking about. So coming directly back to your question, Nancy, I think there are two main lines here. One is transactions that create more room by shifting risk off balance sheets, and we've seen a whole bunch of things like that, with some of which we looked at, or one of which we looked at in our survey, the room to run transaction, and the various things that followed that. So there's a whole set of those things that are currently either they've been completed or they're about to happen. Like IFC is now doing a securitization, as IDB invested 4 or 5 months ago. So all sorts of things are happening. And then there are transactions that may be encouraged and pushed by particular DFIs, which are broadly off balance sheets. And I think the Bayfront transaction, in which we were partially involved on behalf of one of the participants, and which is covered by our study, is a very good example of that, because it's basically nowhere near the direct balance sheets of most of there was a DFI, a CDO, which invested through Mobilist in the equity tranche, but most of all the underlying securities were coming off bank balance sheets. That was an exciting example of this second type of thing, where it's not directly affecting, a lot of the assets haven't really gone through a DFI balance sheet. So those two areas, we're seeing so much activity right now, and multilaterals and bilateral DFIs are getting stuck in lots of different ways. That's actually creating some challenges for the risk managers of different institutions. But I think that's the way forward, and this kind of imaginative and positive attitude that now even we're seeing within traditionally conservative DFIs is really what's going to contribute a lot in the next few years.
Thanks. That's a helpful intervention. You as you said, you're talking about particular innovations, generally financial innovations that are market building, and for everyone, I recommend William's paper where he scored, and with Mobilis, where he scored these 9 different innovations. And it's interesting you mentioned the room to run approach, which has now been replicated, or not exactly in the same way, but other MDBs have done the same thing or in the process of doing the same thing. So one question is like, how can you speed up that replication process? And it relates to the knowledge sharing that Chris was talking about earlier. There was work in the G20, the Capital Adequacy Report, which highlighted the room to run transactions. Maybe that had something to do with it. But I think one question is how do you spread this? How do you diffuse these innovations more quickly across the system? So, Alessandro, so what's your perspective on what would speed up both the diffusion of good innovations that have market impact, but also enable MDBs in particular to use all of their tools more effectively to drive market impact?
Sure, thank you. There are many elements here we can look at, but I would like to focus on a couple. So I think Chris mentioned the point of having a programmatic approach, a very explicit and intentional programmatic approach. So to think about not only one transaction, but a series of transactions, a portfolio, and or a country approach where you have in mind that you need a sequence of investments, you need a sequence of upstream work, you need a sequence of elements that can produce this effect. This is something very much we see that. It's very difficult to hit a home run with one transaction. You need to have much more a programmatic and systemic approach in terms of how the way you look at your portfolio, the way you manage your portfolio. This is why we move to work from even a portfolio management to a sub-portfolio management. We want to be very explicit in how we work in certain areas, certain countries. And then let me say that something that we found that I was mentioning before, the private-public synergies that we're trying to really to be very intentional, very focused on as IDB group. But and this is something, for instance, our impact rating tool that now we're reviewing, that we're going to put a lot of emphasis on these synergies and how much an investment is not only relevant in what was to achieve and also market level effect, but coherent with our investment. And there I think where there's a big opportunity among MDB to foster this coordination among ourselves. I think that if we want to achieve systemic effects, market level effect, the firepower we have in terms of different organizations working together, working to catalyze private sector capital, and working to trigger and take those risks in those countries that will allow for those capital to flow in. That would be, I think, transformational. So, and that is something again that we want really to push us very hard in our selection process in the future. So internal synergies within the group, but also looking at the synergies with our multilaterals. How we're doing something that fits into a programmatic or transformational approach that can leverage on all these resources. The second element is that is always highlighted is MDBs needs to take more risk, and we agree on that. And I think that we have and again going back to the portfolio management, portfolio learning. I think that we can learn a lot from our transactional portfolios. When we say that sometimes risk is overstated, is perceived twice, true. When we look at our portfolio, we see that sometimes the private sector markets are a little bit shy on sectors that we do see we can operate well. And so how do we take more risk in those sectors, how we de-risk ourselves, and in a way by sharing risk with credit insurance, securitizations, things that we already work on, and continue signaling to the market that there's a possibility to have a good ratio risk return from those investments, and working on those financial risk and non-financial risk. The other part that we especially in sectors that are new, or they could even have reputational risk or construction risk, that we know that, again, a very active portfolio management, learning a lot from our experience, learning a lot from what works, learning a lot how we can deal with those non-financial risk, how we can manage our portfolio transaction is fundamental in creating, a reputation that we're willing to go in, taking risk, manage risk, work with those situations, and show both our investee and our co-investor that we are able to stick to those situations, and working in those cases would be very important for keep moving capital. And again, we have the privilege to have resources we can use in terms of upstream and advisory work. So use that very, very intentional and very, very synergic and coherent with the investment decision we take all together. Finally, I think that also this idea in terms of integrating risk and reward mechanisms, everybody here has experimented with this performance-based incentive, linking the achievement of certain development outcomes that are also in a way related to taking certain risk. I mean, serving certain unserved population is always related maybe to taking certain risks. So try to push the private sectors towards serving those population and rewarding them for taking those risks with this performance-based incentives. I think something that we can do. But those are a few ideas. For me, I would say that really if we can coordinate better together, have a programmatic approach together, leveraging on each other, that would be really transformational. There, I think, where we can really have a big impact.
Thanks, Alessandro. Very, very. I commend the level of ambition in your remarks, and also you anticipated one of the questions from our audience, which is how can MDBs better support at the programmatic level, bringing a strategic approach to project selection. So let me turn to Maria. So you are already coordinating clearly with IDB Invest and IFC in the context of this report. But what would make your job easier in terms of promoting market impact? Are there barriers, either in terms of risk tolerance or other things that are standing in the way of a focus on impact and impact results, market impact results?
Yeah, I mean, just to be additive, I do think that addressing the risk optics and the risk tolerance of those that we're trying to mobilize, right? So you have to think about, like, who are we trying to catalyze in, what types of investors, and what are their barriers, right? Is the question we're always asking us. What is their barrier, and what needs to be unblocked to get them to look more seriously at these types of investments? And risk is, especially, we operate predominantly in Africa and South Asia, so risk, real or perceived, is usually one of the biggest blockages. So, I agree largely with what William was saying, which is, we really should be focusing on what financial instruments or new ways of doing transactions will help address that risk. And so, we at BII are fortunate in a way in that, we take a portfolio approach. We have different pools of capital that have different risk tolerances. So, we have a catalyst pool that can take on more risk. We've got concessional finance. We have technical assistance where we can provide some of this advisory work and market creation, upstream type interventions. And so, I think our focus increasingly, and what I'm, pushing us to do is, like Alessandro said, take more risk, but, use it in a quite strategic way. We can do all sorts of financial instruments. We can do everything from risk sharing to blended finance, first loss, guarantees, and we should be thinking outside the box and, creating financial instruments that help address this sort of risk tolerance of the people we're trying to mobilize. So we're very focused on that at the moment. And, I think with the more we can collaborate with others that are doing the same thing, blended finance, we're seeing an increasing amount. I think the more that we can come together and agree on the parameters and where we come together in these capital stacks would also be quite helpful in terms of catalyzing more volumes of capital.
Thanks, Maria. I'm very glad you raised the question of more catalytic financial, changing the instrument mix to more catalytic products, which is perhaps the single most important decision that institutions take in terms of boosting their mobilization performance, apart from the question of market impact. And BII is fortunate in having these different pools of capital that have different risk tolerance, perhaps something that other institutions should take a look at. So let's now go to Elvira and then to Chris. From your perspective, maybe picking up on some of these issues of risk and instruments, what would drive more impact and also more private investor interest in investments that drive impact?
Yeah, thank you. Oh, thank you, Nancy. Yeah, maybe 2 points from of course, my perspective. I think what we can only say is we hope that all the MDBs will have a continued focus on bringing in the private sector where possible. I think it's exemplary what the IDBI, Invest has also been adopting already a few years ago, originate to share, bring in the private sector where possible. I appreciate the comments that are being made on securitizations and programmatic approaches, but I just also want to really underline the fact that our investors like the project-by-project approach. They get a lot of information per project. They like the impact reporting that come with that project-by-project information approach. That has also allowed them to really appreciate the asset class for what it is. So not using blending, so we have no guarantees, no first losses in our portfolio, because we have been able to show to them, what this asset class is, what the returns are, how stable they have been, how non-correlated they have been with financial crises in the past, how low default rates have been. So we really strongly believe that for a lot of the transactions that are being considered by the MDBs, there is an appetite from the private sector to participate. So I think that is the appeal that we will do, because we also do this on a funded basis. So the more we can participate, the more capital is being freed up on the MDB side to take that capital forward, use it for opening markets where we may not be able or ready to go. So I think from our perspective is having it in your DNA, whatever transaction you source, is this a transaction that you can source to the private sector, because there's much more appetite than might be believed by the MDBs. And maybe as a last and final point, Nancy, you will not be surprised that we will continue to plea for transparency, talk about the asset class, the GEMS database and the publication that we recently saw has, of course, tremendously contributed. We hope to continue the dialogue, because more familiarity, the more MDBs talk about the performance of the asset class, the more familiar the private sector becomes with the asset class. Specifically in these turbulent times, we need more talk about how steady this asset class is and can be. So I think from the private sector perspective, that would be the gains that we would see in overall driving market impact.
And I think it's your point about your investors liking the project-by-project approach, because they get a much clearer sense of the actual impact. A really important point. Again, it points back to quality of measurement and quality of reporting. And I'm so glad you mentioned the GEMS database, one of my favorite topics, because this notion of correcting risk perceptions by using the power of MDB's own credit track record, it seems really something that's fundamentally beneficial to all parties, including the MDBs themselves. And we've seen some progress, but we need to see more granular data. So over to you, Chris. What are your thoughts on all this?
So I think there's one thing, excuse me, that we really need to focus on, and that's sort of the strategy and the mandate that's handed down from MDB and DFI shareholders. I think it's really positive we're seeing this progress from own balance sheet deployment of capital towards mobilization of private co-investment. I think if there was a mandate, a more explicit mandate handed down to focus on market building, we would see things flow in slightly different directions, many of which we've touched on here. So as a boring economist, going back to sort of the market failures that we're trying to solve, including the information asymmetries that we've touched on, I think wouldn't be unhelpful. I think we would then see what in William's paper and our previous work as well, we call this transition from originate to distribute to originate to demonstrate, sort of really being a slightly different business model, effectively, that MDBs and DFIs can engage with. We've talked about ex-ante decision-making, ex-post monitoring. All of that would flow from such a mandate. It would also mean that we move from, as you said, Nancy, conversations, seemingly interminable conversations about GEMS, to much more specific conversations about ILX and the assets that you have in your fund, and the dialogue you're having with your investors about those assets. There's very little point in our view talking about the GEMS database if there aren't opportunities for investors to gain exposure to those assets. So I think it's really important that we complement conversations about the data with conversations about the specific assets and the investment strategies that are available to allocators. I would be remiss if I didn't say a word about public markets and encouraging more MDBs and DFIs to consider investing in the public markets, or the role that they can play in building those markets because of their informational content and the transparency that comes with them. And then very finally, I think the point about accelerating capital velocity through this originate to distribute model has become almost mainstream, almost routine in these conversations. But I think one aspect that isn't focused on enough is that not only does holding those assets longer than is required deprive the market of access to those assets and those exposures, but it also deprives the market of information related to those assets and exposures. So accelerating capital velocity also accelerates informational velocity, if you like, and that's, we think, really important if we're serious about demonstration effects and triggering these replications by private actors, ideally without any involvement from the development finance community in the future.
Great. Two great phrases: originate to demonstrate, and a mandate to prioritize that, and then informational philosophy, or sort of innovation diffusion, speeding that up. I think are very useful context in this. Very useful concepts in this context. We have a few minutes left, and there are a couple of questions I wanted to put to any of you that are interested in answering it. One has to do with market building in local currency terms, either sharing exchange rate risk or promoting more local currency assets. What do you all have to say about either the MDB role or innovations that would speed up the development of those markets? And then the second is this question of concessional finance. Several of you have mentioned this question. Elvira very clearly said that's not necessary for the ILX model. But do you see a role for concessional finance here in terms of increasing the emphasis on market impact and increasing the ability to achieve market impact? What is the role of concessional finance, if any, in this context? So local currency, role of concessional finance. William, go ahead.
So on local currency, ultimately, if there's going to be hedging on substantial scale, so that entities outside these local markets can loans, so entities like DFIs, then ultimately there has to be issuance in these markets. So a combination of market development efforts to develop local markets and then issuance within those markets, I think is really necessary. The two things can't be done separately. The markets have to be developed, and then also there has to be greater issuance within those markets. I mean, I think that some of the DFIs have started to do significant issuance. I mean, again, there was an announcement today by Roberta Casali of the volume of local currency financing that they engaged in recently. And obviously, EBRD has sort of led the way in this, and some other MDBs have also made significant efforts, but I think there's lots more to be done. And I think the emphasis on market development, I mean, it should be kept high in that, because basically the capacity to do significant market raising of funds, can only be achieved if the markets themselves are developed. And that's why people like EBRD have been so clear on both issuing local markets and helping those local market actors to both the authorities and the investment institutions to move forward.
If I may, Nancy, just touching base on this, I think that the local currency, I think, is one of the topic that our origination team is mentioning the most. The need to be able to work with local currency, and we're very proud to be moving from, being basically we used to say many years ago, mono-product, mono-currency organization, now having multiple products and be able to operate in several currencies in Latin America. We invested a lot in terms of expanding our capacity. And I think if you want to work in developing local markets, the ability to work with local currency, if the market is generating revenues and returns in those currencies, you need to be able to work also in those currencies, and this our mission to be able to take that risk, manage it, and create the infrastructure, the financial infrastructure, so we can operate in those currencies. And that is what is really a big part of what we think we should keep progressing. On blended finance, I think it can play a very important role, especially when we're working in markets where there are high externalities and where we need to be in a way and absorbing those externalities through some concessional funding, and that way we need to be very explicit and clear in how we deploy them, what type of effects or positive effects we're producing using those resources. So being again very parsimonious and focused and clear on the effects we want to produce by deploying that part of that type of resources. I know I will pass to others if they want to say something about this.
Yeah, I just wanted to chime in on the concessional finance. I think from just having listened to the conversation with respect to the IDA private sector window and how to allocate those subsidies, I think there's a strong desire on the part of the donors to target those subsidies for operations with broader market impact. So you have very scarce funding for subsidies is going to get scarcer and scarcer, likely, and so you want to get the maximum bang for the buck, both in terms of mobilization, but also probably more importantly for poorer countries in terms of market impact. But the question really is does concessional finance fill some function that is constraining a focus on market impact and results? And I'm not getting a sense that that you have that view. that you need some subsidies to increase market impact. But maybe that's wrong. Maybe you need subsidies to do some of these, to take on some of these risks and provide the kind of technical support that you need. But what, you know, a little bit more conversation on the role of subsidies here.
And Nancy, maybe I can start here. So yeah, I think we definitely believe in the role concessional resources can play, whether it's in providing for funding for the MDBs in terms of advisory services, whether it's supporting early stage technology risk, whether it is participating in loans in high risk countries. We obviously do have a certain lower bound of country ratings in which we can invest. So definitely we see, you know, these resources are scarce. So we are a strong believer that please use the subsidies and resources there where it's needed most. And that is most of, you know, in the examples I just mentioned, creating markets, helping early stage development, early stage equity, feasibility studies, technologies that are not yet tested. I think at the same time, we strongly believe in scaling up then private sector capitalization. Don't use it there where the private sector should be comfortable. And that's all about, you know, giving the comfort about the asset class, you know, being patient. It took a long time also before ILIX could, you know, just convince pension funds, you know, this is a mature asset class, but we're there yet. So the asset class can stand on its own feet. So we hope that, you know, for those investors that can take sub-investment grade risk, you know, that they can scale up and provide the resources to the MDB activities where there's no first losses are needed. At the same time, those resources do have a function, but in a very selective, you know, purpose, I would say.
That's a helpful distinction. Just to return to the local currency issue again and the exchange rate risk management, the question from the audience member has to do with using TCX as a global platform for managing currency risk. And it goes back to what Alessandro and Maria have been talking about in terms of collaboration. Why, you know, this seems to be an area where it's ripe for MDBs to share risk. You know, because if they're doing hedging products or participating in issuance, in local issuance, they would want to do it together, both to diversify and to limit their exposure. So do you all see sort of collaboration across MDBs as a critical sort of potential success factor here?
I could maybe jump in, Nancy, if that's okay. So I think clearly there are advantages to collaboration across the MDBs and DFIs with regard to the objectives and the risks that we're discussing today. But I think across both of the questions you asked actually on local currency and on the role of concessional finance, I think, again, if we took a demonstration effect lens to this, the question is what signal are we sending to investors if the MDBs and DFIs are only investing in hard currency and they're requiring some concessional funding to enter these markets, right? We're sending the signal that these are not investable markets or assets. So I think Elvira really captured well the importance of minimizing the role of concessional finance and in the catalytic ways that Elvira was describing rather than as a sort of crude subsidy. And similarly, to the extent possible, working in local currency and demonstrating that actually a lot of these currencies are more robust, more resilient than a lot of investors assume. But also, to the extent that we're working in local currency, we're also then triggering the development of those money markets and currency markets so that in the future, hopefully we won't have to rely on TCX in some of the more mainstream emerging market currencies. But those hedging products and derivatives and so forth would be available from private providers of those products. So I think, again, if we took a market building lens to those questions, we'd maybe come to different answers than taking an own balance sheet investment lens.
I very well said, Chris. I think that everything you said. We share that. And of course, cooperation among MDBs in the topics of local currency is fundamental. And going back to the Elvira, I very much second what you said in terms of building markets. And when you plug in the word subsidy, start to be a little bit dissonant, no? So this is why it's very important that you really focus. If you have a first mover, high externality in terms of demonstration effect because of the new technology, then there you can, and adding maybe on top of that social impact of that innovation, they're okay. Then you say, there's something where we can deploy some concessional funding or on the upstream work you can have. But if you want to get to the point that these the markets that are self-sustainable and they're credible and they're investors that will believe that there are good risk return to invest in, there you need to be very laser focused on where you deploy this kind of resources and
Can I just say, works on analysing and measuring balance sheet risk for a set of different MDBs, and I think that assuming significant on balance sheet market risk, risk really is not a very advisable thing. It would rapidly start to eat up the risk-bearing capacity of these institutions, so their very high ratings would be, less credible. And so I think, there are two routes, which is either to have an off-balance sheet fund of some sort that manages, that provides riches, like TLS, or the MDBs can do their own, raising of funds in local markets. And so those are sort of two different approaches, but I really don't think that MDBs would be well advised to start running significant local currency risk within their own balance sheets on an unmatched basis.
Yeah, I think that's also useful clarification. What I was going to say is that for these very high risk activities, first mover and other high risk activities, there needs to be some way for MDBs to manage that risk, either through off-balance sheet subsidy funds, guarantee funds, or through additional capital, which is a good way to manage more risk. But that's different from subsidizing private sector returns directly. So, and I think that's I think that was implicit in what Elvira was saying. That's one case is how to help the MDB manage that risk while maintaining the ratings that William was just talking about. And the other issue is subsidizing private sector returns. And going down that road is not sustainable, and it's also not an attractive proposition at all to the source of those subsidies, which are governments and taxpayers. So very useful distinction to end on. This has been a really interesting conversation. I want to thank our panelists for really great contributions from various perspectives on this. There's lots more to discuss as we move forward, and I look forward to a future event where we actually start looking at more data on market impact and comparing projected impact with actual impact. So all of you should expect an invitation in the future to another conversation. But thanks so much for your participation, and thanks to our audience for joining us and for asking such great questions, not all of which I had a chance to get to, but thanks so much. Bye-bye.
Thank you.
Thank you.